All right, Joe, we're almost ready for you.
All right. Good luck, guys. We'll go ahead and get
4:15.
started.
Okay.
Ready.
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Joe Bicella, Director of Client Success here at Chaikin Analytics, and I'd like to welcome you to our presentation of proven ways to profit from volatile markets. Presenting today is Mark Chaikin, founder and CEO of Chaikin Analytics. This webinar is being recorded, and a copy of which will be sent to everyone who has registered for today's presentation. Please submit your questions throughout the webinar using our GoToWebinar chat window. Now, before we get started, we would like to introduce a guest to the webinar. A close friend of Mark's for 15 years, Scott Andrews, is co-founder and CEO of InvestiQuant Incorporated, an innovative financial services company helping traders and self-directed investors achieve their financial goals using robust historical market analysis and predictive analytics. Prior to InvestiQuant, he co-founded the Master the Gap and SciQuest, which he took public as CEO. Mr. Andrews earned his MBA from the University of North Carolina and served as an Army aviator after graduating from West Point. To get us started, here's Scott Andrews.
Thank you, Joe, and thank you very much for this opportunity to be here with Mark. I consider Mark a personal friend and mentor. I've learned a lot from him, and I'm just always so excited when I can introduce him to our friends and clients and others of you as well. If you don't know Mark, let me just say a couple things about his character, because I think his tools speak for themselves. He's got a huge following, but Mark befriended me, picked up the phone and called me after reading a small book I'd read called Understanding Gaps. And we just talked trading, and what was really interesting was how humble he was, and I was actually nervous when I realized who I was speaking with, because he's created so many famous technical indicators, and some of which I was using and still use today. And he's just always been a mentor, and no one made him do that. And he told me, I asked him one time, I said, what can I do to help pay you back for the help he's given me? Because Mark is a world-class probabilistic trader. What he does, an investor, what he does is had a huge influence on how I analyze the markets as well. I'm using shorter time frames. But when I asked him that, he said, hey, just pay it forward. Pay it forward, do something nice and befriend someone else. So I've never forgotten that. And I think it says a lot about who Mark is and his commitment to this industry. So for our clients that may be listening and friends, I do want to sort of give you an orientation here to think about it. Mark's going to talk about profiting from volatile markets using some of his tools. He's going to talk about option trading and swing trading. And probably his best tool, or the one that catches my attention the most, and I think it dovetails the best with what we use and do, is this power gauge rating. You can use the tool to find the equities and the markets that are best positioned to continue in a certain direction for a period of time. Then using our swing edges and shorter term tools, you can use them to ride those winning trades, or use our tools to better time entries into the power gauge trades. So Mark's going to stretch your mind, I assure you. Mark, again, thank you for giving me the opportunity to be here and to give us such great support over the years. So I'm delighted with that to introduce you to Mark Chaikin.
Scott, thank you very much, and welcome everybody. Really appreciate the large turnout from the InvestiQuant community. Scott's pretty much done my webinar job for me. I could pack up and go home, but we've got an awful lot to teach you, so I'm not going to do that. Today's webinar is entitled Proven Ways to Profit from Volatile Markets, and we're going to show you some of the recommendations and suggestions that we've made on webinars in the recent past, and how to specifically use the Chaikin tools, as Scott says, in conjunction with the Swing Edges service and the Navigator service that Rob Hanna writes, and how to extend out your trades. So let's get started by way of giving you a little bit of introduction to me. I've been on Wall Street for 50 years, lived through 10 bear markets, and I'm still standing. And that's key, because you've got to be able to survive the bad in order to be there for the good times. For 45 years, I've been using technical analysis as a companion to fundamental analysis. I figured out early on when the first bear market I ever experienced surfaced in 1969-70 after I had lived through 2.5 years of virtually a straight up market when I got registered as a stockbroker, that in a bear market, fundamental analysis is worthless because analysts are inflexible, they stick to their opinions. Firms don't like to put out sell recommendations. So very early on, I realized that you needed technical analysis so your clients could both survive and prosper in bear markets. Along the way, I've been mentored by some of the smartest institutional investors. So when I reached out to Scott, it was my way of paying back because both as clients in our institutional brokerage firm that we sold to Reuters and as associates at various firms along the way, I was mentored by some very, very successful investors. And what I learned from them is embodied in the Chaikin Power Gauge rating. It's the culmination of my life's work, and it's a 20-factor model that does the fundamental analysis for you. You don't have to do that work in the same way that the swing edges service and the gap service do a lot of number crunching for you. The power gauge rating does the fundamental heavy lifting. We've been fortunate to be on CNBC and Fox Business and be quoted on MarketWatch and NASDAQ and Forbes. And most importantly, right in the middle of this testimonial page, 2 months ago, Barron's wrote us up in their electronic investor column and called us one of the top 2 quantitative sites on the internet. High praise from Mike Hogan, who's a very, very demanding writer. Now, I'd like to ask you this question. Has the current market volatility spooked you? Do the headlines affect your day-to-day trading? If they have, please type a big S in the question box for spooked. And if you're not spooked by volatility, please type in what is causing you sleepless nights. Is it wondering about whether we're heading into a bear market or how the election's going to affect drug stocks or the US dollar? What's really on your mind? Because I'd like to address some of that in this webinar. And Joe will step in and give me a little bit of a heads up on what's affecting people right now. Joe, if you're watching the questions, just give me 2 or 3 themes that you're seeing in there, please. Well, Joe may have stepped out, so I'm going to tell you what I'm seeing, which is that volatility is a big concern to people and market direction. Where are we headed? The market's been very choppy as of late. So in January, I called 2016 the year of living dangerously. This slide comes from a webinar that I did in January. I keyed in on 5 things that I thought were really important for traders to understand in 2016. The impact of future interest rate hikes, we've all seen what that does to the market just in the last few days. Commodity prices, where will oil and steel and copper headed? And the fact is that oil bottomed out in 2016, so has steel prices, reflected in a lot of big moves in commodities. Is the dollar going to remain strong or is it going to weaken? Well, the fact is it's sold down dramatically and now it's moving back up again. Breadth divergences were very much on our mind because the rally from April 2015 and the rest of the market action up to January as the market was selling off was accompanied by very huge breadth divergences. Very few stocks in the S&P were driving the market. That's all been resolved to the upside now, which, as you'll see when we analyze the market, which is the first thing we're going to do for you, encourages us to be much more positive about the market than a lot of the analysts that you're seeing in CNBC. And then finally, what were the strong and weak sectors likely to be? So I'd like to focus beginning of the webinar on something that all of our clients ask about. And when I'm at a conference like I was last week in California, which happened to be advisors who are now using our product, although we created these tools for individual investors to level the playing field, advisors have caught on to the fact that Chaikin can help you find profitable investments and, most importantly, avoid disasters. So where is the market headed? Well, in order to help you know that, we have 3 proprietary indicators within Chaikin Analytics to help you gauge where the market's going. Chaikin Money Flow, which I first introduced in 1982, it's on every platform, Reuters, Bloomberg, but you can also get it for free on street.com, and we have it bundled into our smart charts on Chaikin Analytics. So we like to check the Chaikin Money Flow for the spider, and we'll show you how to analyze it in 1 second. We have something we call the power bar. For every index, ETF, list in Chaikin Analytics, including the ones you create yourself, we have a power bar. What is the power bar? It's on the screen right in the middle, and it's the number of stocks with bullish, neutral, and bearish power gauge ratings, the 20-factor fundamental model, in a list. So right now, in spite of this choppy action and downward action of the last 3 weeks, the power bar for the SPY is still positive. There are more bullish stocks based on the power gauge rating and the fundamental potential than there are bearish stocks. And then finally, a very powerful indicator that almost nobody looks at. How is the RSP, the Guggenheim equal weighted S&P, doing relative to the S&P 500 itself? Now, most of you know that the S&P 500 is a capitalization weighted index. That means that Facebook, Amazon, Netflix, Google, Apple, ExxonMobil, and IBM, the largest capitalization stocks, have the biggest impact on the index. And as we'll see, one of the problems in 2015 into 2016 is that the FANG stocks were moving up, but the average stock in the S&P was not. So what we used to say when I started out on Wall Street is, when the generals lead, the foot soldiers have to follow for the market to maintain a solid uptrend, and that's in the days of General Motors and General Instruments and General Electric and General Telephone. And that's how that phrase got coined. So what's happening in the stock market right now? Well, on the right side of the chart, you can see that the power bar is strong. How do we know that? Because as of last night's close, 108 stocks in the S&P had bullish ratings as opposed to 84 with bearish ratings. From April of 2015 through February, that power bar rating never got positive. That's why the market couldn't get through 2100, which is the upper red line. Go down to Chaikin Money Flow, right in the middle of the chart. Money flow is strong. It turned positive or green in January. This looks back over 21 trading days, measures institutional buying and selling. Since mid-January, Chaikin Money Flow, which normally fluctuates between red and green and back again, and when I first met Scott Andrews, this was my primary go-to indicator. It didn't have a fundamental quantitative model. That stayed green the whole time, January through May. How many months is that? Looks like 4 months to me. That's unusual. That's why I've maintained a bullish bias within this current trading range. And then finally at the bottom is the relative strength of the Guggenheim equal weighted S&P. That means each of the 500 stocks has the same weight. So Google or Amazon has the same impact as a stock with a $5 billion market cap, and these companies have $400 and $500 and $600 billion market cap. So all 3 of our proprietary go-to indicators are positive, which leads me to believe that there's no bear market coming, and we're going to maintain this choppy trading range market, volatile as can be, that we've been living through for the last month. Today was an example of that. S&P was down 23 points at one time in the early afternoon, finished down 6 or 7 points. If you don't have a rock to tie your line to, you're going to drown. And these indicators can be your rock. Now let's look at how we got here, and then we'll move on. two W-shaped bottoms. How many of you know and have lived through and have taken advantage of W-shaped bottoms? If you have, please type W in the question box. Well, the market can bottom in two ways, V-shaped bottom or W-shaped bottom. This is the letter V or the letter W. From 2011 in October through April of 2015, every bottom was a V-shaped bottom. And not one of them exceeded 10% in terms of peak to trough decline. But in August of 2015, we got that waterfall decline on August 24th. I call it Market Order Monday, when people panicked when they saw the Dow futures down 1,000 points pre-market. And they put in market sell orders on ETFs when the individual stocks were not trading. That created that cascade. You rallied up. What happened to Chaikin money flow? We boxed it in red. It stayed red on the rally. Huge rally. I'm channeling Donald Trump here, guys. Huge rally from 1867 on the S&P cash to above 2,000 in just 2.5 weeks. Money flow should have gone positive. It didn't. You came back down, you made a lower low, and Chaikin money flow was green. And as you came off that bottom, which in the cash S&P equaled the previous low at 1867, but because of those market order dislocations in the spiders and other ETFs, it didn't get down anywhere close to the low, which was closer to 1800 in the futures. You rallied up and money flow came in, the institutions were buying the rally. But you stalled out at 2100, just like you did in April, May, June, and July of 15. Then you came down yet again, and guess when that decline started? It started on December 15th, when the Fed raised interest rates. Now, it should have been no surprise. My colleague John Schlitz, who writes our Morning Insights, and by the way, you don't have to watch CNBC for 2 hours prior to the opening to know that the futures are down or up and what happened in China and Germany overseas overnight, because John does that for you in his Morning Insights that comes bundled with Chaikin Analytics. But when we bottomed out after the Fed started raising rates, and by the way, John did a study that said you should have expected a decline of about 5 to 6% after the Fed raises rates, but then you're going to go back up and rally sharply. That's exactly what we did. Came back down after the middle of the W. Look at the difference between the two bottoms. Here, money flow stayed negative. Here, in the middle of the W, money flow was green or positive. The institutions were either covering shorts or buying that rally. So when you pulled back and tested the low at 1810, money flow was positive. Is a very powerful indicator on the S&P. It can be used as a companion to the work that Rod Hanna does at InvestiQuant. But as you rallied off that double bottom on February 11th, and guess what triggered that bottom, although he won't take credit for it, Jay Diamond, CEO of JP Morgan Chase, announced that he was buying $25 million worth of his own stock. He's got about a 30% profit on that right now. Market went straight up from there, and look at the money flow. Institutions were with that all the way. So leading up to the current market, where I view it as strong, we had a very powerful W-shaped bottom. Very unusual, by the way, to get two W bottoms in such a compressed time framework. That's volatility to the max. Now, if you're looking at broad-based ETFs, typically you have three that you're trading. SPDR, triple Qs, which is the NASDAQ 100, large exposure to biotech and tech, and then the IWM, which is the Russell 2000 small cap index. Now, our relative strength indicator goes from red to green. It's right here. And by the way, the power gauge rating, which is at the bottom of the chart, is grayed out. Because right now we only have power gauge ratings on 5,000 individual U.S. equities. By the end of June, we're going to have power gauge ratings on all equity ETFs. First ever combination of predictive model on ETFs based on fundamentals and technicals. We're going to roll up our power gauge ratings for the individual constituents in an ETF and then do the technical analysis on the ETF itself. This is the way you can find the best ETF. So, but right now, relative strength is a very indicator. So what could this have done for you? Well, in late January, the triple Q, which had been outperforming the SPDR, the broad-based S&P 500 large cap index, started underperforming. That was at the bottom of the February W. And it's been underperforming ever since. So the rally in the triple Q stalled out well short of its high, whereas the rally on the SPDR came much closer and still holding the uptrend line. And this is reflecting the weakness in the tech stocks and the biotech stocks. So if you have to make a choice between triple Qs or SPDRs, the place to be right now are the SPDRs. And if you want to make a more nuanced choice, the RSP, the Guggenheim equal-weighted S&P, which by the way has $8 billion in it. SPDR has somewhere around 70 or 80 billion in it. Still very tradable. The equal-weighted S&P is the place to be because it's outperforming as we saw. So the meat of today's webinar, now that we've covered the market, and I hope that this has given you some context for your trading, because you've got to know in your heart what direction you think the market's going. You don't have to be right day or the week, but you have to have a sense in order to guide your shorter term swing trading. But we're going to be talking about 5 steps for profiting in volatile markets. It starts with the power gauge and Chaikin relative strength on individual stocks to find the stocks with the highest probability of outperforming or underperforming the market. Chaikin money flow, as we've seen on the SPDR, can help you anticipate future movements. We think sectors and ETFs are a great way to put the wind at your back. Look for sectors where the predominant power bar is bullish, more bullish than bearish stocks. And then we're going to talk about how you can play good defense, avoid landmines that tend to destroy your portfolios, and actually profit by knowing which stocks are likely to go down. And then finally, how to use options during earnings season to profit from volatility. Now, we've just been through earnings season. It ended today when Walmart reported better than expected earnings before the opening. But over the next 4 weeks, we'll get companies like Federal Express, FedEx, and Nike reporting. So there's some key companies that report outside of earnings season. And then again in July, we're going to prepare you for that. Boy, Walmart had its biggest one-day up move, almost 10% in 3 or 4 or 5 years today. So it's been a heck of a ride during earnings season, but today's webinar is going to prepare you for the earnings season that starts in early July. Now, we know from feedback from the more than 3,000 people who are using Chaikin Analytics that their biggest problem is information overload. We live in the age of distraction in our personal lives, Twitter, Facebook, LinkedIn, email, total distraction. In the stock market, you've got all this information on CNBC, Fox Business, conflicting views, scare headlines, services that pretend to be expert and really are just tossing a coin. We live in the age of distraction. Information overload is a huge distraction. The key to making money in the stock market as a swing trader or an investor is focus. So what Chaikin is all about is enabling you to focus in the age of distraction. And that's why it's so compatible with what Rob and Scott are doing at InvestiQuant. They help you focus by zeroing in on the highest probability swing trades, and we give you a lot of color and context and a third-party independent opinion of the stocks that they're talking about. So the solution that we have to information overload is Chaikin Analytics for iPad and desktop. We've been nominated for a Benzigo Award, and they asked me for a tagline that best characterizes Chaikin Analytics, and I said, we tame big data. Big data has become a big buzzword. You've got cloud computing stocks that claim that they can sift through all the data and find these patterns for you. Well, Scott and Rob do that. Chaikin does it. But that's how I would best characterize Chaikin Analytics. We tame big data. We've also integrated an options idea generator from a company called Options Play into Chaikin Analytics. Now, when I saw Options Play, I said, boy, I wish I had developed that. It's the best options product I've ever seen. One of the brokerage firms that I've worked for was Tucker Anthony and R.L. Day, regional brokerage firm with over 22 branches, and I headed the options department there. And Options Play is a dream for traders. So if you're following swing edges and looking at their swing trades in the spider or in individual stocks or ETFs, Options Play can help you find a high probability options idea that's consistent with what you're hearing from Rob at Swing Edges. And I'm going to show you examples of options trades that we've talked about on webinars or featured in my weekly market insights as our bullish or bearish trade of the week. So we're going to intersperse that with examples on the Chaikin platform. Now, how does Chaikin lead to larger profits? We do that by giving you a directional edge. Rob and Scott are doing that in a short-term basis. We're doing it on an intermediate to longer-term basis, but it's still valuable for short-term traders. The power gauge rating has predictive value 3 to 6 to 12 months out, but the best performing stocks over the next 6 to 12 months are also going to be the best performing stocks over the next 6 to 12 hours and the next 6 to 12 days, because it's not like Superman where you leap over tall buildings in a single bound. It's day by day, one step in front of the other. So we give you the directional edge by analyzing the fundamentals, combining them with proven technical indicators. The output is a quantitative model called the Chaikin Power Gauge Rating, and then we also give you buy and sell signals for better entries and exits. It's a complement to what they're doing at InvestaQuant. So volatile markets demand a disciplined methodology. Otherwise, you're like a rowboat in a hurricane, just getting tossed from here to there. A weather vane is another good example. So this pyramid encapsulates a very simple but disciplined methodology. My wife Sandy is using this, and she gives webinars called From Novice to Knowledgeable. And you get advisors on those webinars who give us feedback that, boy, Sandy's proven that it doesn't have to be complex. She's actually trading these signals, these patterns. The top of the pyramid, bullish power gauge rating to find winning stocks, bearish to find losing stocks. That's the fundamental potential. ETF and sector strength is also very important because it can put the wind at your back. At the bottom of the pyramid, two only technical indicators, Chaikin money flow and Chaikin relative strength. You've seen them both when we looked at the spider. And right in the middle, buy and sell signals. Obviously, if you're a swing trader, timing is terrific. You've got a great resource in Swing Edges, and we can complement that for you. Now, the Chaikin Power Gauge rating looks deceptively simple, doesn't it? It looks like the gas gauge on your car. It goes from very bearish to very bullish, but please don't confuse simple with simplistic, because under the hood, you've got a Ferrari engine. And the reason I can say that with confidence is that the Chaikin Power Gauge rating, and I'm going to spend a little time on this because to buy into this discipline methodology and the examples we're going to show you, take advantage of it going forward, you've got to understand what the power gauge rating does for you and why it's been successful in the 5 years that it's been commercially available since January of 2011. It's got 20 factors, 85% fundamental, only 15% technical. And these factors are there because they're based on what I learned working with institutional investors. The large institutions look at fundamentals. Fidelity, T. Rowe Price, Vesco, big hedge funds. And by the way, we have some big hedge funds using Chaikin Analytics. In the old days, it was Soros. They're still a client. Paulson, hedge fund. Legendary hedge fund of the current era, using Chaikin Analytics. They look at fundamentals. And the factors in here, sort of anchored by the financial metrics, which are our value metrics, 35% of the model, are what Warren Buffett looks at and any other good value investor. We also have some factors in here that are much more sensitive because the value factors don't change that much. But I boxed earnings surprise and earnings estimate revisions because I learned this from George Douglas at Drexel Burnham, who built one of the best quantitative databases on Wall Street in the 80s, and his research findings with me. Earnings surprises, which are very rare season that just ended, as we'll see, happen when companies report better or worse than expected earnings. Now, everybody is writing this off now because we all realize that management can game it by lowering their estimates to the point where they virtually have to beat them. Well, that didn't help Macy's and Nordstrom's and Gap and Ross stores. I'm sorry, Kohl's didn't help Ross stores after the close today, but last week, no amount of gaming could avoid the fact that these companies missed and guided lower. When that happens, or when it happens on the upside, as we'll see with a company called Tyson Foods or United Health, analysts change their estimates. Analyst estimate revisions, which I learned from George Douglas in 1985-6, are the single biggest driver of short-term stock price movements. That was true 30 years ago, and it's true today. And that's why these factors are in the model, along with short interest and insider activity and analyst ratings and industry group strength. This is what we call an eclectic model. It finds a lot of ways to like or not like a stock. It's been effective over 5 years, and you'll see some proof. And it will continue to be effective. We've never changed the model. We haven't changed the weights. They were frozen in September of 2010, so almost 6 years ago. And that's unusual in this quantitative space. Now, how has the performance of the ratings been? This chart combines the out-of-sample performance going back to 1999 with the in-sample performance over the last 5.5 years. And they've been pretty much the same, so I'm comfortable doing this. But by the way, out-of-sample performance on any model or trading system always looks good. So be a skeptic, because nobody's going to stand up here in a webinar and say, I've got this system not working very well in the recent past, but I'm confident it's going to start working tomorrow. They always show you great results. The fact is the power gauge rating has proven itself for the last 5.5 years. Average, very bullish stock, 420 at any given point in time, and the Russell 3000 has had an average gain of 20% a year over the last 16 years. Average very bearish stock, even after a 7-year bull market, has been down 1%. You go to 2015 and it's much more dramatic. In the Russell 3000 last year, the average very bearish stock was down 17%. How many of you experienced the pain of being in a Kinder Morgan or a Range Resources, or even a Union Pacific, or Sun Edison or Solar City in the solar space? These are the stocks that contributed to a 17% average decline for the very bearish stocks. Average very bullish stocks down only 1%. Russell 3000 is also a cap-weighted index. The average stock in the Russell was down almost 8% last year. So the average very bearish stocks 1,000 basis points worse than the average stock in the Russell. The very bullish stocks almost 700 basis points better. That spread is the directional edge that Chaikin Analytics gives you. Now, 2 final proof points, and then we'll get on to some learning materials that will serve you very well going forward. We have 2 partnerships, one with NASDAQ, which was launched on April 1st of 2014, and one with First Trust Portfolios. First Trust Portfolios, based in Chicago and now Austin, Texas, is the largest creator of unit investment trusts. They operate under the radar screen, but they initiated $57 billion of unit investment trusts last year alone, and they're the 10th largest creator of ETFs with their AlphaDex ETFs. Chaikin and First Trust formed a partnership. We helped them create the Chaikin Low Beta Growth Portfolio Unit Investment Trust Series 1, which launched on December 7th of 15 with a second series on March 4th and now a third one coming up on June 1st. And the first two series, even though they're low volatility, have been outperforming the market since inception. Now with NASDAQ, we created three indexes based on NASDAQ benchmarks, large cap, small cap, dividend achievers. The bottom line is they've outperformed their benchmarks for 2.5 years. But the trick here is that you can only rebalance the portfolios once every 12 months. Same with the unit investment trust. The handhold portfolios that advisors use to put client money to work that have to be in place for 13 to 15 months. Can't make any changes no matter what happens. So look at the dividend achiever. Vanguard has a dividend achiever ETF. VIG's got $26 billion in it. They matched that benchmark. Over the last 2 years and 2 months, that means that they were up about 7.5%. NASDAQ Chaikin Index, using the power gauge as the overlay to find the best of the best in that 234 stock list, up 17.75%. That's almost 400 basis points a year. Imagine what that would mean on $26 billion. It's an awful lot of alpha, additional profits, by following a disciplined rule methodology with an underlying quantitative model that really works. Now here's an example of a stock in the First Trust Unit Investment, Tyson Foods, one of the 20 stocks equally weighted in that Chaikin Low Beta Growth Unit Investment Trust. It embodies everything that's good about Chaikin. It's powerful predictive value of the power gauge, which is on the bottom, our relative strength indicator, good Chaikin money flow, series of positive earnings surprises, big spikes up, capped by yet another positive earnings surprise a week ago, Monday, before the opening, and the stock in a down market rallied from about 62 to 67. So even in a down market, stocks with positive earnings surprises can go up. And you see right on the screen with our earnings module right at the top, they reported on Monday, May 9th. They beat estimates. How do you know that? That little green exclamation point. We color-coded the earnings reports. You can drill down and get the detail. So now let's get into the meat of that discipline methodology. How do you know what to buy? Classic Chaikin bulls. Bullish power gauge rating, relative strength is strong. Chaikin money flow is green, not red, telling you that institutions are buying the stock. Here's an example of that. United Health Services, also in the Chaikin Low Beta Growth Unit Investment Trust, had been in a steep downtrend from July through February. How do we know that? Well, series of lower highs and lower lows. Doesn't have to take a difficult, complex algorithm. You can just see a downtrend staring you in the face. But things turned around. The institutions started buying it here in February. How do we know that? Money flow was green all the way from early February through the current trading this morning. Power gauge turned bullish in March. The stock was 122. And then it started outperforming the market. At that point, the market was agreeing with the model. We have a name for that. You'll see it in a minute. Very important if you want to extend out trades, the swing trades that you're getting from Swing Edges or Navigator, to have this combination going for you. So you can turn a 3 to 5 day trade into a 3 to 5 week trade. If the power gauge is bullish, the stock is outperforming the market, and the money flow is positive. And those can be your big profits. Now you can take the trade off in that short-term time framework by selling 50% of your position if it's profitable and riding the rest with a stop based on what Chaikin is telling you. Now the classic Chaikin bear is the mirror image. Bearish power gauge rating, meaning this stock is likely to underperform relative performance. The real world is confirming that, and Chaikin money flow is weak. Here's our poster child. A year ago, our poster child was Wynn Resorts. It stayed bearish for almost 18 months, and the stock went from 200 all the way down into the 60s. Kinder Morgan has been our poster child for a year now. A lot of advisors that we talk to were challenged by their clients about why they shouldn't buy the stock up at 40 with a 20% dividend yield. Well, the power gauge wasn't fooled by the dividend yield. You can see at the bottom, all red for over a year. And in that period, Kinder Morgan was underperforming the market the whole way, and I've circled in yellow an opportunity where Kinder Morgan rallied from under 30 to about 33. It was a 10 or 12% rally, and look at the Chaikin money flow. It stayed red or negative. There's that pattern. It repeats over and over and over again. It's done that for 30 years. Now, what does that mean to you as a trader? It means you want to buy put options or go short Kinder Morgan when it gets overbought. In this case, it made an 8-day high, and that combination of bearish power gauge, overbought, and 8-day high right there at the 21-day exponential is what we call an overbought sell signal. It's one of 6 pairs of buy and sell alerts in Chaikin. It's a gift. Does it work 100% of the time? No. This signal itself works 2/3 of the time and usually yields a 5 to 10-day trade. When you get Chaikin money flow negative, that really should amp up your confidence level. And confidence and conviction are the key to making money as a trader. You've got to be able to pull the trigger. And yet another opportunity very similar to that here, and then again right here. And in spite of the fact that Warren Buffett and a few big hedge funds have announced to the world that they're buying Kinder Morgan, the stock really can't get going. So classic Chaikin bear. Now, how do you find these stocks in Chaikin? 2 ways. Chaikin hot lists have power gauge hot lists and featured bulls and bears. We do the heavy lifting for you. This display was actually from a webinar I did a month ago, and I kept it up there because a lot of these perform very, very well. Reliance Steel, RS, flagged a month ago, been a huge performer, channeling Donald Trump again. Tyson Foods, United Health, Micron, which is a somewhat troubled company, actually saw the power gauge go bullish as it's making this basing pattern. It's almost like a cup and handle. So very powerful way to find bullish stocks, but you can take control and find stocks using our new stock screener that meet your criteria. So what have I done in this screen? Again, this screen is a month old, and I like to do that to show you how well these did. I took stocks in strong industry groups. We give you the ability to start with any universe you want, from all 5,000 to large cap value, large cap growth. In this case, I started with stocks in strong industry groups that had a bullish Chaikin power gauge rating. Reduced 5,000 stocks down to 88. I then said I wanted the 1-month money flow and relative strength to be strong, and that got me down to 66 names. Mid and large cap stocks only 46, and I needed a buy signal in Chaikin within the past week, 23 names. That's how easy it is. That took seconds to do. And some of these stocks have been excellent performers. Steel Dynamics, Reliance Steel, Entergy. These have been performers over the last month or so. The utilities are in here. Everybody's saying the utilities are overpriced, overvalued. Well, they may be, but they perform very well. So I said that this combination of the Chaikin power gauge and relative strength had a name in Chaikin. We call that the dynamic duo. And the reason we do that is because the dynamic duo finds big winners and big losers. When the Chaikin power gauge rating and Chaikin relative strength are both positive, those are the stocks that are most likely to give you price acceleration on the upside. We're going to show you an example of that in a minute. Superior returns come from stocks that outperform the market. It's been true since I started doing technical research in 1966. And it's true today. Dorsey Wright has built a whole business that they sold to NASDAQ based on the concept of relative strength, and way back in the 60s. And in the 50s, people were using this to make money, and mutual funds and institutions were using it. There's one caveat, however, right in the middle. Relative strength stands alone as a bullish or bearish indicator. Now, what do I mean by that? Well, you've all heard the phrase momentum trader. Maybe some of you are momentum traders. If you're a momentum trader trading a high volatility stock and the power gauge rating is bullish, that's fine. But you get many stocks that go up, as we'll see, with a neutral power rating. And they're outperforming the market. So relative strength can stand alone as a bullish or bearish indicator. But be mindful that if you're trading a stock from the long side that's a high flyer, like these cloud computing stocks, Solar City, whole host of stocks in the last 2 years, and the power gauge rating is not bullish, it means the fundamentals are not supportive of the move. It's either overvalued or the analysts don't like it, but for whatever reason, it's a high-flying stock. Be prepared to exit the party quickly as soon as something goes wrong because you're on a high wire without a safety net. Now let's look at an example of that, which is Owens Corning. Power gauge rating at the bottom has been bullish off and on for over a year with a little bit of neutral. And the stock has in general been outperforming the market. It's in the building products group. We had two momentum breakout signals. You went above the upper Keltner band, volatility band that we use, here in March and then again in April. Now, typically when you get a momentum breakout, the stock consolidates for 3 to 5 days, and that's a great entry point. It's not going to sell off a lot, especially with money flow so strong. So in a webinar that I did a month ago, Owens Corning was around 51, and I said if you had followed Chaikin, and we highlighted this in our weekly market letter as a strong stock and a strong industry group, you had a profit of anywhere from 10 to 12%, but you may have felt that there was more to go. So how can you use Chaikin to enhance your returns? Well, using the integrated options play module, on that webinar on 4/18, I said with the stock at 51 making a new high, assume that you had bought 200 shares, you could write 2 covered calls. In this case, with a strike price of $50, and you can get $2.30 a piece for them. The raw return was 4.5%, but if you repeat that every month, because this was a strategy with a 1-month time horizon, May 20th expiration, that's tomorrow, that's a 51% annualized return on top of the profit you already had. Now these options are probably going to expire worthless because the stock is under 50 today. So by writing those calls, you brought in additional income to enhance the relatively low yield of 1.4%. And now they expire worthless, the stock sold off, you can do it again. And we got this testimonial from Jim Davidson in April. He said, I'm better night's sleep and impressive returns after getting hammered in the August correction. I decided to take advantage of what Chaikin really offers. That is a better night's sleep and some impressive returns. Rather than swinging for the fences and striking out, I've learned to do what the system tells me and enjoy my 16% return. Jim Davidson is writing covered calls on stocks with bullish power gauge ratings. Thanks to the Chaikin team for giving my confidence and a good night's sleep back to me. And thank you, Jim, for that great testimonial. Now, here's an example of the dynamic duo of relative strength and the power gauge rating on the downside. Twitter, a stock we all know. Donald Trump loves it. People use it every day. And the power gauge rating's been bearish for over a year. The stock has been underperforming the market. Therefore, the dynamic duo is weak. Now, I highlighted 2 areas of the chart. On the left, money flow stayed negative all through that period in the spring and early summer of 2015 when the stock gapped down to around 35 after a negative earnings report and then went sideways for 3 months till the next earnings report, which was a bearish surprise. And you could have used the fact that the Chaikin money flow stayed negative to sell any of those rallies or buy put options. The same opportunity again in December when money flow deteriorated and the stock couldn't penetrate its uptrend line. We actually put out a put recommendation in our weekly market insights that made over 200% by the January expiration. Now, we've talked about the dynamic duo. The second takeaway, the second pattern that I want you to firmly grasp and embrace is the concept of personality changes. They are the key to making money consistently and keeping it in trading. Now, what do we mean by a personality change? We mean a stock that's gone from outperforming to underperforming. So our relative strength indicator has gone from green to red. You can pick up Investors Business Daily and follow that column of numbers from 1 to 99. I think that contributes to information overload, even though they do great work. We have converted it into a red-green heat map. So you don't want to be on the wrong side of the door when Jack Nicholson's coming through with the axe. You don't want feet in cement. So here's an example, a building products company, Martin Materials. Martin Marietta Materials used to be an aerospace company. It was in a steep downtrend, just like United Health Services, from August through February. And it was underperforming the market with a bearish power gauge rating. So you had every reason to look for put trades and stay short this stock and avoid it on the long side. But then in February, the institutions started buying it after this highly volatile price action around their earnings, where the stock made a new low and then spiked higher when people saw positive guidance from the company. And the money flows continued unabated. In March, you had that bullish personality change. How do we know it? Because our relative strength indicator went from red to green. It's really simple. You don't have to outguess the market. The market always tells you what it's thinking. The stock was at about 155 on its way to 85 or 188. And then in late April, with the stock at around 170, the power gauge turned bullish. So now you had all three key Chaikin indicators lining up, and the stock has moved in a sideways to down market from about 170 to 188. You've got to recognize these personality changes in order to stay whole in the stock market. Don't put your feet in cement. Too many of us fall in love with a stock or love to hate it and don't recognize that the market is changing. Now, SunEdison is an example of the dynamic duo, power gauge and relative strength, working on the downside, and a bearish personality change in July when the stock was $28 on its way to bankruptcy. Money flow stayed weak the whole time. Many opportunities to sell this stock, and we'll use this as an example a little later in the webinar. But here's an example of stock with both the dynamic duo weak and the bearish personality change. Very important that you spot these changes. Now, the third way that you find profitable opportunities in volatile markets is by knowing what group and sector strength or weakness is all about, because strong groups give you tailwinds and weak groups give you headwinds. So Chaikin enables you to use sector and group ETFs to trade profitably. We're going to show you how to drill down on the Select Spider sector ETFs, the 9 sectors in the S&P 500, find the strongest sectors and then drill down on them and find the strongest ETFs based on the power bar ranks, and then finally how to find the strongest groups in the strongest ETFs so you can supercharge your portfolio. From our list manager, I've taken a screenshot this morning of the 9 Select Spider sector ETFs. 6 of them have power bars better than the S&P with more bullish than bearish stocks. One of them particularly stands out. Consumer discretionary is very bearish. And let's see what we can do with that information. Well, I'm going to drill down on healthcare, which is ranked number 5. Now, you may say, why not go for 1 or 2 or 3? Well, there's a very good reason. Many of you have been hearing and reading about the concept of sell in May and go away. If you have, type a big SIM in the question box, please. And I know from your initial comments that a lot of people are concerned about this sell in May, go away pattern. Well, it actually does work, but not in a way that really helps you in May. It works because most market bottoms in the last 50 years have come in September and October. So of course this 6-month time period looks bad. But there are two sectors that go up in this 6-month May to November period: healthcare and consumer staples. How do I know this? Because Sam Stovall at S&P has published all these studies. You can Google them on the internet or buy his book, 7 Market Secrets. So let's look at the XLV, which is the large cap select spider sector ETFs. Very liquid. But it's been underperforming the market. How do I know that? Because there's the relative strength indicator. It's not green. So there's a better way within Chaikin. Go to our list manager. We categorize all these equity ETFs by group, by style, by market cap. So let's drill down on all the healthcare ETFs. So we don't have to settle for just the large cap. And there, right at the top, is the XHS. It's the Spider Healthcare ETF, but it also includes small and mid-cap stocks, which in the healthcare sector has been a good thing because the big biotech stocks have not done well. And right under that is the First Trust Healthcare ETF, our partner in the unit investment trust business. So we drill down by tapping on XHS and we get this chart on our desktop app. And lo and behold, the XHS is outperforming the S&P. So if we're looking for a healthcare ETF to trade on the long side, we want to do XHS and not XLV. And on the left, you see the strongest stocks in that ETF because we rank all of the stocks, and there are about 54 of them in the XHS by Chaikin Power Gauge rating. And of these top 15 names, guess what? 4 of them are in the Chaikin Low Beta Growth Unit Investment Trust: HCA, UHS, McKesson, and United Health. You can do with this very simple methodology what our computers cranked out for First Trust in that rules-based methodology to create these outperforming unit investment trusts. Now we also have sector and ETF performance graphs. In this case, I'm looking at the 9 select spider sector ETFs, but I'm looking at their price action for the last week. And I see that there's healthcare at the top, along with financials. And at the bottom, discretionary, consumer discretionary staples and utilities who are experiencing some profit taking. So I've highlighted consumer discretionary, and I can see the biggest names in that sector. Amazon dominates it at 11%. That's got a bullish power gauge rating. At the bottom, you've got McDonald's, Starbucks, and Nike. They've had bearish ratings. There are no retail stocks in here other than Home Depot. But yet the retail stocks are a big component in the consumer discretionary sector. So let's look at how we can take advantage of that knowledge. We go to the select spider sector groups, 20 of them. Right at the bottom, there's your power bar for the XRT, the retail ETF, with 6 bullish and 42 bearish stocks. That's where the downside risk is. Here's what the chart looks like. You had a bearish personality change back in July, and the retail ETF was toast. In October, Macy's, Nordstrom, Kohl's all reported bearish earnings surprises, steep drops, and guess what? That pattern was repeated just last week when Macy's, Nordstrom, and Kohl's reported negative earnings surprises and guided lower. You had it again after the close on Ross Stores today. The only one that's bucked that trend, TJ Maxx. So here's what the Macy's chart looked like. Back in October, we actually put out a sell recommendation on Macy's because we had a money flow sell signal. That means the stock got overbought with a bearish power gauge rating and red money flow. And here's that other pattern back here in August that we told you about. This is like gold, folks. This works over and over and over again. You get overbought, power gauge ratings bearish, Chaikin money flow is red, and you get either an overbought sell signal or a money flow sell. You can take those to the bank. Are they going to work 100% of the time? No, but they are your highest probability swing trades. And if Swing Edges is finding them, then you really know you've got something. But yet again, Macy's disappointed. We had a sell signal back here in March at a price of about 43. They disappointed last Wednesday. The stock spiked down 15%, trading at about 30. Money flow, relative strength, the power gauge, all bearish, and the XRT trading poorly. That's an example of the group wind at your back if you're on the put side with all the other Chaikin indicators lining up. Now, the fourth way that you can conquer volatile markets is by playing good defense, because good defense leads to good offense. So what do we mean by playing good defense? Herb Greenberg, who used to write for CNBC and TheStreet.com, wrote a piece in January of 2014 titled, "It's the stocks you don't own that matter." Herb's a really smart guy. He's left the public writing sector and he's got a firm that sells short sale recommendations to institutions. So by playing good defense, you can avoid mistakes and reduce your risk. You can stay away from weak industry groups. You can know what stocks not to buy and improve your performance by eliminating potential losers. So let's look at a couple of examples of that. Classic example is Chipotle. It was an overvalued fast food chain that was growing very rapidly, and the power gauge rating was never bullish on it in this time framework because the valuations were so high. The company switched to local food vendors. They couldn't get enough beef for their tacos, or pork actually, for their tacos and quesadillas. So the power gauge rating turned bearish in mid-October when the analysts started souring on Chipotle. And then unfortunately they got into that E. coli bacteria problem, reported a negative earnings surprise. The power gauge turned bearish again. It started underperforming the market. You had to be out of that stock between 620 and 630 looking for put buying opportunities. If you were long the stock or long calls, game over. And very little in the way of rallies, but you did get them along the way with Chaikin money flow negative. And over here in March, we put out a sell recommendation, made Chipotle our bearish stock of the week, and on a webinar that I did, we used options play to find a put strategy, because this is a $466 stock at the time. So to control 100 shares of stock, that's almost $47,000. In a margin account, that's $23,000. So options play, the integrated options idea generator, liked two ways to play it. You could short 100 shares of stock, or you could do a vertical put spread. Now, how many of you use options and are familiar with vertical spreads? If you are, please type a V in the question box. And I see about a third to 40% of you are familiar with vertical spreads. Vertical spreads, puts or calls, are almost always a higher probability way to trade a stock, in this case from the short side. So in April, or March rather, options play suggested a May 20 expiration vertical put spread, buying the 470 put with the stock at 466, so it was slightly in the money, selling the 400 put, total cost $2,180, so you could control 100 shares of Chipotle for only $2,200. That's your complete risk. Now when Chipotle traded down to 417 just a week ago, or 8 days ago, that put spread had widened out to over $5,300, so 150% profit as Chipotle went down roughly 12%, from 466 to 417. That's the value of leverage using a put spread and the Chaikin power gauge rating to guide you into a high probability trade. Because options plays, ideas, just like Chaikin's, just like InvestiQuant's, are all based on probabilities. Now, another stock you wanted to avoid, play good defense, as we pointed out earlier, was SunEdison. In that area in yellow, I predicted this company would file for bankruptcy. Did I know anything? Well, I keyed off the power gauge, and then I looked at their business model, and I saw they were doing stuff like Enron was doing in 2000. moving receivables off their balance sheet to make it look stronger to related companies. Classic Enron accounting mischief. And sure enough, the stock filed for bankruptcy. We got this testimonial just the other day because an advisor from Merrill Lynch came up to me at the Advisor Forum conference where I was representing Chaikin, who sponsored this along with BlackRock. So hopefully that's propitious about where we're headed in the world, because BlackRock's the largest money manager in the world. And the advisor said to me, I bought SunEdison at 15, which my firm Merrill Lynch was still recommending on the way down from 30. If I'd been using Chaikin, I would have saved myself, clients, a lot of money and pain. And this is a professional advisor. Merrill Lynch put out a sell recommendation on SunEdison at $3. It's almost criminal on the way down from 28 to 30. So if you're here because you follow InvestiQuant instead of Wall Street Research, hats off to you. But if you're still following Wall Street Research, they're always late to the table. And guess what? This broker told me, because I said, you know, we also had a bearish rating on Solar City. He said, Merrill Lynch still has a buy rating on it. The stock had just dropped 25% because of lower guidance. It's one of Elon Musk's big promotions, along with Tesla. So even advisors are finding value at, you know, strong firms with strong research departments, in theory, at places like Merrill Lynch. Now, in case you think that the power gauge predicting a weak stock that files for bankruptcy is a rare occurrence, I'm going to show you two more examples. This goes back to October 2014. GTAT was supposed to be making sapphire glass for the iPhone 6. Power gauge was bearish in September when the iPhone 6 came out, and lo and behold, there was no sapphire glass. So the stock sold off to 12, but it sat there. Now, guess who financed the factory to build sapphire glass for GTAT? It was Apple. The company ultimately filed for bankruptcy, and guess who's buying that factory out of bankruptcy? Apple. And you can be sure that sapphire glass will show up at some point in the future in one of the iPhones. It's almost like dealing with the mafia, sad to say, because we love Apple products. Now, one final example, and this comes from Jim Cramer, who loves Chaikin money flow, but apparently doesn't follow the Chaikin power gauge rating. So you've got to take control, because even the gurus get it wrong. On April 14th, Jim Cramer said, Energy 21, EXXI, made sense to me. I mean it. Yes, I know it filed for bankruptcy yesterday, so one can only conclude that the company was reckless. Jim Cramer was bullish on this stock all the way down. Had he been looking at the Chaikin power gauge, what do you think he would have been doing? And the relative strength in the money flow. That's right, he would have been shorting the stock. So independent, third-party, objective research based on a 20-factor model can keep you out of trouble, help you turn lemons into lemonade by being on the right side of this with put options rather than bottom fishing. So the final step in making money in volatile markets involves options and earnings season. Earnings season is typically January, April, July, and October. Why? Because most companies are on a calendar fiscal year and report earnings the following quarter. So we've just gone through April earnings season, which lasts about 6 weeks. And there's a lot of volatility in earnings season. And that's an opportunity that some people shy away from, but we think is absolutely critical. There's a lot of speculation in the media around earnings. So how do you know if a stock will meet, beat, or disappoint? Well, the Chaikin power gauge is your GPS during earnings season. You saw it with Macy's, you saw it with Twitter. Here's a recent example. Netflix, ahead of the earnings in early April, the power gauge was bearish. And we had gotten a sell signal. So on our just 1 month ago, April 18th, we used options play to find a bearish strategy for Netflix, which was due to report earnings after the close. And we put this out on our Twitter account to clients. Notice that Netflix was trading at about 110, 108, reported a negative guidance and dropped. And personally, I think the game is over for Netflix for a whole series of reasons having to do with the fact that they're actually losing cash for the first time in 5 years. They lost $750 million in real cash in 2015. That means they're going to have to sell junk bonds or stock to raise money to pay for these expensive original films like House of Cards, which we love, series. But we put out a put recommendation using options play, who liked, again, that vertical put spread. For $381, you could have controlled $10,000 worth of Netflix, in this case for just 2 days. This was a weekly option. And you were betting on the fact that there'd be a negative earnings surprise based on the fact that the power gauge was bearish and we had just gotten a sell signal. Well, Netflix disappointed. The stock dropped to 90 before that option expired 3 days later. And people who bought that put option made over 300% on their money. That's the power of a disciplined methodology paired with a disciplined option strategy. But this has happened before. Before Netflix split 7 for 1, ran up to 700. In October of 14, we had a sell signal just before earnings were due out. Featured it in our market insights. People who bought out of the money put options made over 50 times on their money when the stock dropped 100 points after reporting a negative earnings surprise. But people who bought options closer to the money also did very well. So here's a testimonial from JV. Quick $21,500 profit. Bought 3 put contracts before earnings on 10/15, that's of 2014. $22.20, sold them the day after earnings for $93.90, a quick $21,500 profit. People are using these tools to make money, and that's before we had options play integrated. That integration only took place in November 6 months ago. Now it's even easier to find the right put trade. And then finally, LinkedIn. Back in January, we had a sell signal, what we call a reversal sell. Think dropping down below a 8-period exponential average when the power gauge is bearish. And the stock reported actually numbers that were a penny ahead, but they guided so badly. They said our business is hurting, at least for the foreseeable future, that the stock dropped 100 points. People who bought put options based on that sell signal made out very, very well. Here's one trader who did that. 115% in one trade, 70% in another. I've been using Chaikin for several weeks, and I've already closed out 2 trades of 70 and 115%. Over the years, I've tried many different software packages and programs. This is by far the most straightforward I've ever used. So now you know the 5 steps for profiting in volatile markets. They're all embedded in Chaikin Analytics for iPad and desktop. We now have a stock screener, options play, earnings alerts, sector views, and by the end of June, ETF ratings on all equity ETFs. So how do you take advantage of that? Well, JD has taken advantage of it and gave us this wonderful testimonial. I'm writing to tell you how absolutely incredible Chaikin Analytics has become. It started great, but with the options and screener additions, I feel it's absolutely the best product on the market, and I'm recommending it to my friends. So Chaikin Analytics for iPad and desktop normally costs $1,950 for an annual subscription. As a webinar special for the InvestaQuant community who's been so supportive of Chaikin, we're reducing the price by $200 to $1,750. You can take advantage of that by going to chaikinanalytics.com/profit. The discount will be pre-populated, and this offer expires Sunday, May 22nd. Or you can call the number on the screen or email sales@chaikinanalytics.com. Now, what you get along with the graphs and the screening and the options is the ability to turbocharge your profit with what we add value in our own unique way. You get my weekly Market Insights newsletter with our bullish or bearish stock of the week and my market commentary. You get small group tutorials to help you learn the features and start using them so that you too can experience trading profits almost immediately. You get our new sector analytics plus the stock screener and the earnings alerts, fully integrated, and John Schlitz's daily morning insights, which I alluded to earlier. Comes in your inbox before the opening. So it's a powerful package. And one final testimonial, 10x return in 5 days. In the 5 business days that I've been using Chaikin Analytics, I've paid for the subscription over tenfold. These initial results are nothing short of astounding. Please extend my thanks to the entire Chaikin team. And team is really the key. This is a team effort. Joe Bicella, who organizes the webinars and does the onboarding. And everybody from Michelle to the marketing department to the salespeople who help you learn about the system are dedicated to your success. That's why so many of our subscribers have experienced positive results within weeks of starting with Chaikin Analytics. So how do you buy into Chaikin Analytics? Hopefully I've shown you the value of this disciplined approach. And I'd like to give you a fast action bonus to encourage you to take advantage of this tonight. If you subscribe by midnight tonight, we'll take an additional $100 off, reducing the annual cost of Chaikin Analytics to only $1,650. As John Najarian once said, and I wouldn't dare say this on a webinar that he sponsored for us, he said, folks, if you can't make $1,650 in your first options trade using Chaikin, which I also use, you don't belong in the options trading game. Now, I would never say that, but John did. And as a special bonus, if you subscribe by midnight tonight, the first 10 people who subscribe, you'll get a free one-on-one telephone call with me. They usually last 30 to 45 minutes after you've been onboarded by Joe Bicella and his team, so you understand what's embedded in Chaikin Analytics. And these one-on-one calls are good for you, but they've been great for me as well. So fast action bonus, take an additional $100 off and get that free one-on-one telephone call with me. ChaikinAnalytics.com/profit. It'll be pre-populated with the $300 savings. And with that, I'd like to thank Scott Andrews, who had to catch a plane from Chicago back to North Carolina, and turn this back over to Joe Bicella. But mostly I'd like to thank all of you because over 95% of you stayed with us on this webinar. So that helps me know that we're giving you valuable educational information, and the pitch at the end is our way of saying, take advantage of this because it really works. So Joe, with that, I'll turn it back to you to close it out.
Excellent. Well, thank you so much, Mark. And again, a big thank you to Scott Andrews for joining us for today's webinar. There were a few questions regarding some different ways to use our screener and to use the options play program. We cover all of these during our daily onboard sessions just for our Chaikin subscribers. We have one more session this week before we hit the weekend, so we'd love to have you join us and take advantage of Mark's offer. Again, $1,650 for a full year to Chaikin Analytics only if you register before midnight tonight. So you can send us an email. You can give us a call at 877-697-6783 or go directly to our website, chaikinanalytics.com/profit, and we'd love to have you join us. So with that said, on behalf of Mark and the whole team here at Chaikin Analytics, thank you so much for joining us this evening. Have a great night, and we'll see you tomorrow for the onboard session.